pictures of him. But he's a retired teacher from Elyria Catholic, and has his MBA from Baldwin Wallace, and he is, like I said, presented to us, I think, a couple times over the years. Were you ever at the little auditorium? The big auditorium at St. Joe's Hospital?
No.
Oh, okay. You don't go that far back.
It's over at a church in Lorain and
Okay,
a couple
sure.
of times.
Okay, a couple churches.
Yeah.
And then here. So he makes it his financial sharing very interesting and understandable, and makes me wish I had money to invest. But I'm going to turn it over to Dan.
Thank you. Like Computer Users Group, investing, again, is a philosophy that you share with other people. Like you guys share your computer knowledge with other people. We do the same thing in Better Investing. It's been around since 1951, started in Royal Oaks, Michigan, and I've been a member off and on since about 1976 or so with this organization. And I like their philosophy in that they look for growth stocks, and they have a system or a method of investing which is very easy to follow. Years ago, we used to do it all manually. Now everything is online, and it's very simple to do and change it. And when I was teaching at the school, we would go through this, and they have a sample program out here that the kids could go in and play with it and do the investing in that. And then I'd let them use my logon to go in when we do the stock market game, where they would get $100,000 to invest in the stock market.
How much does it cost to be official member?
It's about $90 a year. And then you get the tools, the online tools. And they have webinars every month that's on different topics and that you can, from home, sit and listen to. And I do them occasionally. They'll have companies. They have what they call First Cut, which is what I'm going to do tonight, is go over, at the beginning of each month, they send you 3 stocks that somebody else has done a stock evaluation on, and they'll explain to you how they make money, how they came up with their judgments, and final judgment is they'll tell you from their recommendation, which they're not recommending for you to buy. That's always a disclaimer that they have. Whether it's in a buy range, a hold range, or a sell range. So it gives you something at least to fall back on to make a decision, rather than simply throwing a dart at a piece of paper and picking out a stock, or listening to somebody that says, oh, this company's going to go up, no question about it. You do your own research. And I've met a number of the people that are speakers and have put on the webinars and that, and they always have their email that you can email them at any time, and they will get back to you fairly quickly and get your answers from them. They also have a magazine that comes out monthly called Better Investing, and when we talked, Rich asked me to talk about technology stocks. I went through this, and they had the people that are buying and selling, and last month more people are buying Apple than selling Apple. More people are buying Amazon than selling it. NVIDIA, more people are buying that. Disney, everybody's bailing out on that, it seems like, for whatever reason. Facebook, people are bailing out on that. There were 61 sales, 24 buys. Microsoft, people are starting to buy that again. Skyworks Solutions is 50-50. And Netflix is another one that people are starting to bail out on a little bit. And Google, people are continuing. So you can get an idea of what people like me or other investors that are doing it are what they're doing. People that don't do investing for a living, and financial advisors and planners. So that's always kind of interesting. And then once a year they come out with their top 100 or 200 surveys of companies that stock investment clubs own, or individuals own, based on number of clubs that own the particular stocks, or the dollar amount that people have in it. And as you might guess, number 1 is Apple, and number 2 is Amazon, and number 3 Google, Alphabet. Then Disney was 4, Visa 5, Johnson & Johnson, Facebook was 7, Microsoft is 8, and then Home Depot and Starbucks were 9 and 10. So you can get an idea here of what other people are buying, and they'll show you a little bit how far they've moved up in the ranks, some of the newer companies when they come out with that. So this is a magazine, one of my favorite magazines that comes out monthly, and I always go through and look at it and read through it just to get ideas for investing.
Just going to mention there's a little bottle of water there too.
Oh, thank you very much.
Just go along.
And the second magazine I want to talk about before I go into the better investing that I like, because I'm a personal finance teacher also, and I like personal finance, is Kiplinger's magazine. For the average person, it's a great magazine, a lot of good articles in there. And I happened to pull this out. This was February's issue, and technology stocks. Is it time to bail? And I was looking through it today, because I hadn't looked at it for a while, and it has like Netflix down 28% from its high, Apple 24%, Facebook 21%, Amazon 18%. And I'm looking at them today, or yesterday and today, I'm looking at them online. Was not the time to bail. They're all up. They're all up now. So again, you know, you're never going to be 100% right. You're never going to be 100% right in this. You're going to pick stuff. And what they usually say is if you buy 5 stocks, 1 or 2 will do better than you expect, 1 or 2 will do about what you expect, and 1 or 2 are not going to do as good as you expect.
So be diversified.
So that's why you diversify. That is so helpful. So this is another one of these are the 2 magazines that I highly recommend to my students. I recommend to anybody that's just looking for 1, investing information, and 2, just personal finance and investing information. And Kiplinger's, I give it up to my kids every year and a couple other people that we have, friends, and it's only $12 a year. So it's very cheap, $1. Better investing comes with your membership, which runs around $90 a year, so that comes with that. Okay, so one of the online tools that I use is the stock selection guide, like I say, and you can keep your studies out there, which I have out there. And these are some of the companies that I've done in the past for schools. A lot of these, like I said, I did when I was teaching. Some of them I did when I was buying. And a couple of them I went through and did Apple and Amazon for tonight's talk with you. And I'm going to start with Amazon. Again, it's a technology company. It's an interesting company to me. It's one that I've always never invested in, never felt comfortable investing in it. But if you look at it, it ended today at 1,800. If you look at Kiplinger's there and time to bail, it was like 1,200. So it's gone up in the last. But talking to my son, who's an Amazon Prime member, I don't know how many people are Prime members. It's just it's changing the whole retail market. It really is changing the whole retail market. Be interesting to see what happens now with the CEO, Jeff Bezos, getting divorced. His wife's going to have to live on about $30 billion a year.
She'll be unhappy with that.
Yeah, that may be a cut in her normal spending. But what this program does, it works very good for growth stocks. It doesn't work very good for banks, utilities, large corporate stocks that don't have growth. We're looking for growth. You know, Warren Buffett, who I own a couple of his B shares, not his A shares, not the 200,000 shares, but I own a few hundred of his B shares. He's a value investor. Value investors look for companies that are out of favor for whatever reason. Okay. In other words, the market hasn't caught up with them. They have something new coming on, and people just aren't buying it now, but they're selling at book value or below book value. And that's what a value investor is. Growth investor, we're looking for companies that are growing. And so what we look for in better investing is parallel and up. And you can see here, Amazon, look at those sales. Every year they've gone up. Let me pull this down just a little bit here. You can see here, 24 million, 34, 48, 61, 74, 88. Every year they're going up. And the growth rate has been about 26%. it can't, I keep saying it can't last. But it keeps growing and growing and growing. So that's what you're looking for in sales in that, is just straight up in that. So the first 3 slides here that we're going to look at is you're looking for sales and earnings. Okay, earnings per share. You're looking for earnings because if sales are increasing, earnings should be increasing along with your shares. If earnings aren't increasing, then there's something wrong. And here's this next slide, which is why one of the reasons I've never bought Amazon. Here's their earnings. It's not straight up and down. It's up, down, up, down, up. And I got a feeling, I'm not sure why it's that way, but it seems to be that, when they invest in new companies, they're not afraid to do new things and lose money. I mean, you look here in 2012, they lost 9 cents per share. They lost 52 cents here. So again, they're not afraid to go into a business and lose money knowing that it's going to catch up. One of the things that I do use all the time too is Value Line. It's a great source of information, tells you timeliness about the company, gives you a summary of what's going on, and you can get those at the library for free.
Yeah. I used to work in that room at the library, and people would come in regularly and check the Value Line and several other of these.
And I was there to get ready for this presentation about 2 weeks ago, and they have a new feature there at the library at the West Branch, where it used to be you'd take it, you'd make a copy, pay 10 cents or 20. Now it's 20 cents. Mm-hmm. Now you can just email it to yourself and print it at home for no charge. I was just
save it to a USB drive usually. They have that as an option.
Yeah, is that an option too? But I just emailed all these to me at home, and I thought, wow, that's slick. I didn't know you could do that. So again, with tech, you're always learning new ways to. So when I look at Amazon here, this would be enough to make me to say, well, I'm not sure I want to buy this stock. Okay, and then the third one is you look at the price, and again, the price pretty much straight up and parallel. Even though they had losses in these years, look at the price; it's still going up. And it's just because of the high volume. And I think everybody in this room has been affected by Amazon when you look at all the stores that have gone out of business. I mean, all the department stores. You look at Sears, you look at Penny's, you look at Macy's, you look at the malls. Everything has just changed. The individual stores really don't stand a chance against them because of their and they're getting better and better on their distribution. Yeah.
I'm just curious, how many people have Amazon Prime?
I do not yet. My kids don't have it.
Well,
but, yeah.
the reality is, what's the first thing you think of when you're going to buy something? I'm going to check it on Amazon.
That's what I do. That's where I go to see what the price
And
is.
I will use the price on Amazon to hammer brick and mortar stores.
Yeah, I will too.
So I go in and I say, here it is. Okay, I want it for that price. If you want to sell it to me,
Yeah, and I do the same
the
thing.
ones that don't do that is Best Buy.
And that's what more and more people are doing, and because they have the price match. They don't want to lose your business. Yeah, Rich?
Hey, Dan, in those years where they lost money, are you able to research the reason why that happened?
I did not have time or did not
Okay,
do
but
that, Rich.
That is something that can be done. Correct?
Yes.
Because I know they're getting ready to launch their own airline now, and that's going to probably be another big hit.
Yeah.
Because they're buying
I'm
airplanes.
wondering, I'm not sure what year they bought Whole Foods in that.
Yeah.
And I'm wondering if that maybe was this one in here. They started out selling books.
Yeah, used paperbacks.
And that was, and you've got to give the guy a lot of credit for what he's turned that book into.
Money the first number of years.
Yeah, they still, yeah. And you go back to earnings, and when I bring Apple up, you'll see a big difference in the earnings. I mean, $2 per share, $2.53, $1.25 per share. And what are shares? If you put your cursor right over the company, you can see that the closing price, should be current, $1,800. That's not a high return on your investment for earnings. A couple dollars per share for that price. And it also tells you what it is, what it does, Prime membership fees, where their money comes from. So any company that you're investing, if you want to find out a little bit about it, you can just put the cursor over the company name and it'll come up. If you want to see how it's doing against some of its competitors, whoops, I think I can do this. You can, they give you some competitors, and you can compare it to some of their what they consider their competition. If you don't like those competitors, or you want to see how they're doing it, maybe against a particular store, like say Target or Walmart, you can change the peers and put in Walmart. So yes,
Did you set that up, or did they?
they set that up.
Oh, okay.
Like I said, I can go in here and change this to what at Walmart I think is WMT. Oops. Go back here. Should let me do it. Yeah, there it is, Walmart. Let me get rid of this one. And there's Walmart. So you can see how Walmart's earnings are sort of flat also. And they're trying to get more and more like Amazon, and Amazon's trying to get more and more like them as far as having actual stores for people to go into.
Isn't there some reaction taking place very subtly that Amazon's getting so large that they're going to start,
Government regulation
like
then?
the old AT&T, putting all these places out of business?
Mm-hmm. How that's going to come out, though, who knows?
How soon? And
Yeah, and what it's going to happen with that. But yeah, and it's the same thing with Alphabet, Google. They're getting so large and so dominant that there is no competition. So, it's like with Microsoft and that, the same type of thing. You're going to see government regulation. I
you have
wouldn't
to have a preview when that's going to happen so you can get out.
get out in time, yeah.
Didn't Amazon just announce that they wanna put up like 3,500 satellites
Yes.
to provide broadband service and,
Mm-hmm.
I don't know, depending on how many
Those are
satellites.
those scrambled satellites.
Yeah, and they want to get it down too, where they can deliver, the same day in an hour with drones and. I mean, they're very ingenious and a step ahead of
Well, they
everything.
was it Amazon that had something called Project Loon? Loon?
I have no
I
idea.
don't know who it was. It was the idea that they would provide the internet from balloons.
Oh yeah.
When Puerto Rico had all their infrastructure destroyed, they were one of the companies that came in. They were actually using, real time. They were using their balloons to provide internet service to washed out areas.
Again, when I don't see the straight up and parallel, that's why I stay away from Amazon. I never buy it. Again, same thing here. You're looking for pre-tax profit on sales, and again, their pre-tax profit is all over the board. Walmart's was down, and then you can see here it's starting to go down. It's starting to change their pre-tax profit. We look at return on equity. You'd like to see it at least flat, if not going up. There's return on equity. I'm sorry, I guess I was wrong. Pre-tax on profit, again, down, back up and down. Walmart, their pre-tax profit is going down. This is the one that surprised me. Not so much on this, but on Apple, it's debt. We look at debt to capital, and Amazon, again, their debt is going up quite a bit here in the last 4 years. You can see here where it's up 87,000. If you go back to 2014, it's 12 billion. 12,000 million or whatever. So you can see where their debt is climbing as well, along with that. But what's more important is their debt to capital, because do they have enough capital to cover the debt? Okay? And if we look at the debt per capita, if we look at Amazon, again, it was up high at 53, and it's 50 or 57. It goes up, goes down. So again, about 50% of their debt in relation to their capital that they have to cover that debt. So they have enough money to cover it, but it is going up. And again, I think a lot of it is because of the distribution costs they're having. And the distribution centers they're starting to put out everywhere and the businesses that they're going into. I tell you, my investing career, I've never had much luck investing in retail. So I stay out of retail and I stay out of restaurants. Those have not, neither one of those have been very good. The only restaurant I did very well in was Bob Evans. And we got into that when the original Bob Evans was around doing the commercials and that. And the reason we invested in Bob Evans because my kids were playing soccer. And every year we'd go down to Columbus for a tournament in Dublin. And right next to the motel was a Bob Evans. I'd never really heard of it. And that's before there was even one in Lyria. And you would wait anywhere from 45 minutes to an hour to get a table. And I said, there's got to be something to this restaurant. If we're waiting that long to get in and that. So we bought it at $10 a share or so and sold it at 40 something a share. And then it went back down and up and that, but I never really got back into it. But and a lot of times that's how you come across a good stock is by you find a product you like. You find a product that other people are using, and you're willing to wait to get it. So you know that that could be a good investment. We look at sales here, and this is where we start to make our judgments, okay? Again, you look at Walmart, their sales are pretty flat. You look at Amazon, again, those sales, that's what we like to see in an investment. I'm going to, and you can put this in here, again, if you had zero growth, if you correct the growth, you could see here it just would go straight out. But we want to look here, and it's returned 26% growth rate. That's awful hard to maintain. And so usually when you do something like this and you're looking to invest, I always try to be conservative, okay? And the people that also do these that are not professional investors and that, we try to be conservative. I'd rather be pleasantly surprised than disappointed, over-optimistically disappointed. One of the things that I like to do is then when I'm looking at what type of growth rate do I want to use, I'll go in here to research and better investing, and I'll come down to member sentiment. And what that is, these are people like me that have done stock selection guides and saved them, and they put them out here so you can see. This guy had 0% in sales growth, 21, 18, 14. You can see sometimes they're all over the range. But you can sort of quickly get an idea of what other individual investors or investment clubs think the growth rates are going to be. And we're going to look at growth rates for sales and earnings per share. And again, you can usually see where earnings per share is usually not as high. They don't go up as quickly as sales. This guy here is very optimistic, 55% earnings per share, 30. So you can see, somewhere in the low 20s, high teens, looks like a valid growth rate. Earnings per share, what he put in there, he put in this gentleman that I borrowed his, put in a growth rate of 3.4% to 4% there at the beginning. In fact, I think that's the one we're working with now. So you can get an idea of what other people are doing. You can also go in and you can look at the company website. You can go into Morningstar, see what they have out there. I like Yahoo. A lot I use Yahoo estimates, Reuters, and that. So you can see what other people, to get a feel for how other investors are looking at the company. And this is just a basic program. I don't have the Core Plus. I'm cheap. The Core gives you a few more options and things, but for how often I use it, and I don't do a lot of buying and selling. If I do 10 trades a year, that's a lot for me. I feel like Warren Buffett sometimes, you buy and hold. You take your time, and then when you see something you like, you buy it. So we'll put in here, this guy used 21%, so I'm going to use his numbers for growth rate. And again, that's less than the 26. I don't like to go much over 20. And you can see when I do that 5 years out, they're looking at a growth rate of 21%. They're going from 232 millions to 604. That's a heck of a growth rate. Very optimistic, I think. I think it's a little bit too optimistic. But that's the first thing you want to look at is what's it going to be like 5 years from today? 5 years, what's it going to be? And then we want to look at earnings. And again, to me, this is, for Amazon, very hard to predict earnings because of these up and down, up and down. They're not afraid to lose money in the short term. I give them a lot of credit. They're not afraid to lose money. And again, he put in 3.4%. And there was some in there 0 and some like that. So I'm just going to leave that in here to go through that. So the next thing then we're going to look at is we're going to try to find a high forecasted price. Okay? And there's a couple of ways you can do it. When you look here, the 5-year average high PE is 257. The average PE is 191. And the current PE is 91. So it's come down quite a bit from their averages on the high. Okay? So somewhere in between, you come up with that, and you're going to take that number and multiply it by the earnings forecast that you put in. Their last 5-year average, again, 257, I think that's way too optimistic on that. He came up with 149, which, and again, he's basing that on the 5-year average, which is lower, and he removed a couple of the outliers. You can come in here, for example, and you can if you don't like something or it just doesn't seem to fit, you can take it out. So then it won't show up on your graph, it won't show up in your calculations. So, if there's one bad year, maybe like it was Johnson & Johnson's when they had a recall of Tylenol or something, you can take that number out because that's not a normal course of business. That's not going to happen every year. So you can play around with stuff like that and change it for there. So when we update this, 149, that gives us a high stock price of 3,546 5 years out. By adjusting this number, you can lower that or you can raise that. And I'll show you here in a little bit how you can judge whether or not that could be an accurate number or not. Then you're going to do the same thing for the low price. And what he did here was he took the current price, if I remember right, and then took it by 20%, dropped it by 20%, saying that, yeah, it could drop 20%. And you can do it that way, or you can put in a low PE if you want. If you look here, or you can put in a recent low market price. The recent low market price, 52-week low, is 1307, okay, which looks like you could do it that way up here, or you could do it down here if you wanted to use that. Whoops. And that. So he put it in up here to use that for last year, and that. So again, that was a recent low market price. And again, if you look at what the current price is, 1,800, that's a good drop. 500 points for stock like that. And then we're going to look at our risk. And they changed this a number of years ago, which I was really glad they used. It used to be 33%. It'd break it out in the ranges 33 for a buy range, 33 to 66 for a hold, and 66 to 100 for a hold range, or sell range. And I'll be darned if it wasn't about 80% of the time it'd come out in the buy range. So then they said, yeah, well, no, you want to buy it when it's in the lower 25%, and then hold it when it's there. And then when it gets in the top 75%, then you want to maybe look at selling it in that. So the current price is right at the top of the buy range. 1867 is the top of the buy range. It's currently, at that day, it's of 1837. If it's in the hold range, then you just sort of want to maybe watch it. I was doing that with Apple for a while, just for my kids, and it just kept going up. And it went up from 168 to 200 in just a couple of weeks. So again, what they do is they break it out in ranges so you can see where it's at. And you can see here how they do that with the lower range, buy range, 560 between the low forecast and high. And so you get an idea of what you should pay for it. Because what a lot of times in investing, where you make your money is at the buy. You don't want to pay a too high a price for it. You want to pay a fair market price, fair value price for the company. So this helps you determine a fair price to pay for a stock. Then what I like to look at is the upside downside ratio, and what's the chances of this stock going up as compared to it going down. And in this case, it's a 3.2 to 1, 3 to 1 ratio, based on the range that it's in and that. And I tell my students, and anytime I get something over like a 10 to 1 or 12 to 1, I know I did something wrong. I need to either change my low price forecast or up my higher price forecast. You should be somewhere between 1 and 10. Okay, otherwise you're being way too optimistic. When your upside down ratio is more than 10 to 1. So again, 3 to 1 is usually a pretty good one, and as we all know, it just seems like this company does live. And then the last area, it looks at what is your return? Is there a payout? Amazon does not pay a dividend. Okay, that's what this zero is. No dividends. So you're looking at a 14% return. And a 14% return will double your money about every 5 years. A little over 5 years. So again, overall it looks like a good stock. But when I look at the beginning of it and the earnings, it scares me. And so I would not buy that one personally. That's what this program does. It gives you things. And again, you can change it. You can go back to it. You can save it. So go back to my studies. I'm going to call up Apple. I want to go through Apple. Then if we have time, if you want to, we can just pick a company and go through it real quickly, and we can see it. Again, if you look at Apple sales, straight up and down, straight up and parallel pretty much, almost a 20% growth rate. In the last quarter, it's gone down a little bit. They're a little stagnant. They haven't come out with anything new. The iPhone sales are sort of flat, and so you're taking a little bit of a chance there. If we look at earnings, though, they're still way up there. Earnings are growing faster than sales, so they're able to raise prices, and if sales stay flat, they can keep raising prices. They can keep making more money. So their growth rate on their earnings, in this case, different than Amazon, is higher than their sales, because their product is in such demand. And when I go to Crocker Park, I'll walk down there around the Apple Store, Dick's and that, and there is always people in there. There is always people in there. So you know there's a high demand still for their product, very high demand. And then again, if you look at the stock price, again, up just like that. So again, Apple looks like a good company. And a lot of the stock clubs and investors are doing that, investing in it. And it looks like it closed at it's right around 197. I think today it closed right around that. I think the date's wrong on that. But it's, so again, there's pre-tax profit on sales up. Again, it's still going up. They had a few down years, so at least the average, last 5-year average is 38. 2018 was 49. So it looks pretty steady. It's not as straight as I'd like to see it, but with technology companies, they like that. They're up and down. They come in favor, they go out of favor. A little more than some of the other companies. Look at that debt, though. I don't know why, but that debt has gone up tremendously since 2012.
How much money did they have to put into, what do we call that new office building, the spaceship or something? It's a circular one in California?
I have no idea on that. I don't know.
Did sales drop and stuff after Steve Jobs died?
Yes. Yeah, people were worried. I mean, you're going to see probably the same thing when Warren Buffett dies with that company. And I own a couple hundred shares of that in the B share. And I think what my own personal thing is, they're going to split off a number of these companies. I think they'll split them off where you own Geico and maybe all the insurance industry. They'll go into a financial industry. So I think that'll happen when Buffett goes on. But who knows when that's going to happen? Yes,
That's a pretty alarming,
debt ratio.
and it's going up quickly. Do you have any idea what you think might be causing that? An intuition, or I can't
I
remember
really
them taking on any kind of big level of debt like this.
There was an article today about Apple talking about the processors that they use in their computers, and they are converting from Intel processors to Qualcomm Snapdragon, which is supposed to be as good as, it's gonna save a ton of power, probably
They
battery
just
power.
announced
On a
those new
hardware level.
services like banking and
Yeah, they credit cards,
media, a
that
media
absolutely,
center,
that
a
was a flop.
gaming center, and
I see what they're trying to do. They're trying to do a lot of,
diversify their services.
just started back, was that, is that 12?
Yeah, I don't know. I'm not a.
Yeah, that wouldn't explain any of that.
Yeah,
Unless they're ramping up to do this stuff.
but well, it looks like now they're either flatten out.
Interesting.
Yeah, I thought it was interesting too when I saw that the other day, Rich. I looked at that and go, wow.
Well, even though they do their manufacturing in China, they're talking about spending billions to retool
Mm-hmm.
to use the new CPU.
That could be it.
And again, there's their debt to capital, about like Amazon, 50%. But again, they got so many dollars over that they have plenty of money to cover it. But yeah, 50% is a lot, I think. With that. So next we look at growth rates again. Yeah, where's my Apple cheat sheet? Let's see if he says anything here on debt. He only set a 5% growth rate. Increasing service revenue is replacing your hardware revenue. Just like IBM went through that a number of years ago. It went from a hardware company to a software company. iCloud software revenues increasing. Value Line estimates a growth rate of about 5%. So he put in a conservative estimate of 5%. Again, same thing. Sales, in this case, the growth is going to be lower than the earnings growth rate. Even though their sales are tapering off a little bit on the iPhones and the iPads, and that their prices are still going up. So if we look at earnings forecast, we're looking at about an 8% return. So earnings, we're looking at a little bit higher return than we are in sales from here. And again, earnings $1.30, $2.16, pretty much straight up. Not like Amazon, up and down, negative numbers. These are like 23% total growth rate over the 5 years. High price, again, we look at forecasting the high price, where we take the average high PE and times the high earnings per share, which we put in there at earnings per share, we put in about 7.9% growth to come up with that $16. If we come back here to one screen, let me go back one screen. There it is. There's where our growth rate, that's where that 16 came in here, based on what we put in for our growth rate. Again, conservative numbers. They're looking at a high stock price of $265. So now we're going to look at earnings. What do we think earnings are going to do? I'm sorry, low price. What could be a low price? And he came up with 157. I came up with 150. He came up with 140 here. And what he did was he took 20% off of the current price. So I did the same thing, and the price had gone up from when he did this, the current price was 175. Now it's at right around 200. So I figured, well, if he did 20%, I'll do 20% and see what that comes up with. So that gives us a low price. And then we look at the current price being 197, which puts it pretty much in the hold range. Buy range 157 to 184. And so he's right in about the middle, not quite, a little bit lower than the middle in the hold range on Apple right now, based on where the current price is showing up at. And then it looks at the gain and loss, what's their upside downside ratio, and in this case it's almost 2 to 1, not quite 2 to 1.7 to 1, so it's not quite as good. What if I was in an investment club or in my own individual investing, I'd look at this, I'd file it away, and I'd just sort of watch Apple. Today it came down a few points, and see if it doesn't keep coming down to where it gets in the buy range. A little bit of patience would pay off in this case. Rather than jumping in now and saying, wow, I missed it, I better jump in now. Let's just wait. Sometimes it never goes that low. But again, you're trying to be conservative and that. So in this case, I would just pass on Apple. I'd sit, put it aside, sort of watch it in the paper, and I might even put a mark on there to let me know that, hey, when this drops in value, send me an email. Maybe let me know and I'll look at buying it.
So the service will also do an email if you set a price range?
You can get an alert, yes.
Okay. Is that part of the premium, or is that included with what you have?
I've never done it, so I don't. Let's see here. Quick step. I know it's in here. I've seen it.
What did you mean about email then?
We just knew that it was supposed to be.
I know you can get an alert on it. I'm not sure how, but again, and Apple, one of the things they did talk about was raising the dividend, and you can see that the dividend increase here has gone up. Here, their payout 6%, 20. So they're paying out dividends and that. And again, when this one we look at potential price appreciation, that is not as good as Amazon. I think Amazon was a little bit higher, if I remember right. 6.17%. Current yield's 1.5. But those are the two most popular technology stocks that we have. But yeah, I'm not sure if you get the alert here, or if I get down save to my studies. If I want to save it, okay. You can put notes in there on something if you want to put some notes to yourself on how you did stuff and that, so you can remember where information come from at the end, and you can print that out on your stock selection guide. So. Let's see something. Update, edit, delete, preview data, export in another format.
These are things you've done?
These are all the stocks some of the stocks that I've done stock selection guides on over the years, throughout the years. I did a lot of them when I was teaching in that. We'd pick out a company and then go through it in that, with that. And so, yeah, I just leave them out here. There's Google. We did a number of years ago. Number of technology. Yeah, Rich?
How come, did you say that Amazon did not pay dividends, is that correct?
Yes.
But Apple does?
Yes.
Why is that?
Dividend, it's a option of the company. In that a lot of times when companies have so much money in cash like Apple does, they'll pay a dividend. Let me see here if I can find it here on this,
It's the computer doing something.
what the dividend is. Let's see here, cash earning. dividend. Apple's paying currently a $2.72 dividend. They started paying a dividend in 2012. So
So if they don't pay a dividend, the value of the stock just goes up, and that's your reward?
that's how you make your money is on the capital gain. They call it capital gains.
Oh,
It's all capital gain, and you're not taxed on capital gains until you sell.
uh,
Dividends, you pay taxes on the dividends every year when you receive them. So if a company doesn't pay a dividend, then you don't have to pay any income tax on that gain on that. It's like Berkshire Hathaway. Warren Buffett never pays a dividend. There's no dividend on those stocks, on his stock. And reading about him, his philosophy is very simple. I can do better with the money than you can.
That's the assumption.
I'll
you buy a
reinvest
stock.
it. So his stock never pays a dividend.
Do you have any of those, $100,000 hypothetical portfolios stored?
With me?
On your program or anything?
No, I don't.
Okay.
That's a school-sponsored thing. Stocks $100,000. Let's see.
Could you do it on the membership that you're showing us?
Not through Better Investing.
Do-
There
can
is a
can you
program
track
out there.
Your actual portfolio, and will it, follow along and show you things about your portfolio you might not necessarily see every day? Like Morningstar does,
Yeah. Can I see my values every day? Is that what you're asking?
You
Yes.
see activities on your
Yeah.
values. I mean, without you having to input anything, that it just picks it up from a central source.
No, it'll pick up the price
Okay.
monthly. Monthly, I download the prices.
Okay.
Um,
You actually have to go and do something.
Yeah, daily, quarterly or monthly, I have to put in any dividends that I receive,
Yeah.
and that when I buy or sell a stock, I have to put it in manually.
Well, yeah, it
doesn't
would
do-
not know that you did that, but
Right.
it should know how much the dividend was.
Yes, yeah, but, yeah, somebody asked me, we're talking about, for my own portfolio, my wife's portfolio, I use Investment Account Manager. It used to be associated with Better Investing. It's owned by Queenix, and
Kleenex, did you say?
what do you Queenix, Quanix,
Oh,
Quanix, Quanix. Not good.
Nothing to sniff at.
Yeah. Anyway, and what I like, I've had this for a number of years, and it's $99, and then you pay a activation fee every year. Is that I set up 3 portfolios. I have one for my retirement money, my IRAs, my 401ks, and that. I have one for my wife's IRAs, 401ks, and then I have one for both that are not IRA. So I can set up. So we have 3 portfolios. We started putting money into the kids' college fund, and I could put I don't have it on there yet, but I could put their portfolio on there also. So you can set up a number of different portfolios for your investment purposes.
And she can figure this all out. If you get a head injury, she'll know where everything is.
Yes, my wife. She's
A lot
not.
of people don't.
Yeah, she's not real computer literate, but she knows enough to at least where it's at and.
Your password.
Yeah. Yep. Yeah, we got smart a number of years ago with everything. She got a little book there where we have all our passwords and user IDs, and we don't use one of those services online. I don't know if anybody does in here to track all your passwords, but we have it in a hard copy book. Some things I think are easier to do non-computer.
Yeah.
It's like photographs anymore. You don't see photographs. You look at them online, or kids send us pictures online of it. There's no photographs. Okay. Let me go back here.
Now, you said Facebook was not doing so well now, or they're leveling out. Could we take a look at Facebook real quick? Is that possible?
Yeah.
Another answer.
I did one a while back. We can look at Facebook, Rich. There it is. Let's look at Facebook here. Again, if we look at Facebook, 2010 to, that was done 2004. Let's see here, let me, where can I go to update? Well, let's do this. What's the symbol for Facebook? FB? Let's just create a new one. Okay, now we got current data out there. Again, sales look great. And I remember when it first came out. We look at historical. Again, when the growth rate, wow. Price. Pre-tax on again, you can see how technology companies go up and down rather than debt. They don't have much debt. 2 is 16, 7.
Penalties they have to pay.
Debt to capital. Let's see, 51% growth rate here. Sales, let me go in here. See what member sentiment says about growth rate. Again, even though the 50%, you can see they're, again, very much conservative. 20%. They seem to be just in the news too much for me.
Oh, yeah.
And I'm not a user of Facebook. But some different numbers there, 13, 20.
Have you ever looked at Linux International?
I'm sorry, what?
Linux International?
Linux.
Linux?
LIR?
Hang on, you want to call it up or?
Well, yeah,
Sure.
I don't know if you've ever looked at it before.
Yeah, I've not looked at it. What was the symbol?
LIR?
L
I.
I.
L-I-I.
There it is, Linux International. Sales only about 3% growth rate.
And that's what's starting with 09 and 2018.
Closing price at 276. Eating,
Yeah, I worked for Linux.
oh, okay.
And they had their initial,
IPO.
what is it called?
IPO.
IPO.
Initial public
IPO. IPO.
And it was like $18 value, and they let the employees buy it for half. So
Oh,
I
good.
bought a number of shares for about $10 a piece,
Mm-hmm.
and I just keep watching. I've never sold a share of it, and that was in like the year 2000 or 2001.
Well, it's, like I say, it's gone up. If you paid $10 a share, you've done very well.
I know my Fidelity people, they just keep saying, you gotta sell something. You got too much of your money. I
Too many
like
capital
company, it's
gains.
just- I didn't pay anything for it, you know.
Yeah,
Even if I lost it all, I didn't-
stock price on Linux?
276.
You lost for 10?
Yeah.
Right there. Yeah,
You might get this stock selection guy to watch that one.
So I didn't know what they thought, you know, cause I never
Yeah.
bought, anymore. They just keep putting the dividends, in the savings.
Mm-hmm.
Cause it was being rolled over and buying more stock.
And they're not
than the
reinvesting the
dividend.
dividends.
Right?
You're not reinvesting the dividends.
Not anymore. Not, Fidelity
execute me on that, Barnes, Barnes or something, Barney,
Smith Farm?
Smith Barney?
yeah, they were handling it, and everything was being rolled back into purchasing. And then when Fidelity took over, I didn't even pay any attention. They just took the dividends and put them in the savings. Next thing I know, I got, $2,000-3,000
in savings, yeah.
And I go, what are you doing? I thought you were supposed to be buying more stock with it.
You have to set that up.
Yeah,
Well, you can have them switch it back.
I know.
Yeah, you can switch it back if you want. Yes.
You can also change it.
I'm just curious, like, when
also
you're
work with
teaching
Chuck.
this to what age students?
High school.
Oh, high school, okay.
Yeah, anywhere from freshmen to seniors.
Did you ever teach
Find
them
out.
the,
Step on the cable.
from the ground up as opposed to on the website?
You're stepping on
No.
the cable here.
Oops, sorry, I thought, no, I never did that on the manual
Better
forms.
investing worksheets, I had stacks.
Yeah, no, I never did the investing worksheet with the students and that,
Okay.
because it's been,
I finally pitched it all.
no.
All
You,
different
you know,
colors,
you
all
s-
different types of-
when I worked for York for a number of years, which used to be Luxair and Elyria,
So did I.
and I was there in the 80s,
So would my sister.
and they had an investment program there where you could buy their stock in January for 15% below the market value.
Wow.
So if it was selling at $100 a share, you would pay $85 a share. At the end of, in December 31st, you would get your shares. If it had gone up, you know, you could sell them in a week if you wanted, or you could make payment. And let's say it dropped to $50 a share. Well, then what they'd do, they'd reduce the cost by 15% and they'd give you a refund. So you couldn't lose. So even if the stock went down, at the end of the year, the price they would quote you was like $35 to $40, and then they would give you a refund on your overpayment. And I was amazed at the number of people, not only in the plant but in the office area, that says, "I don't understand the stocks." I said, "Do you understand 15%? You can't lose in this."
Yeah.
And
Companies always are trying to get employees to participate so that the big shots
yeah.
can get
Get
a
them,
bigger
that's
slice.
exactly why they do it, because they can put in a lot more. They're 15, you know, they had a percentage of your salary you could put in. I maxed it out every year, and I know they were putting in more.
If they just showed, here's the money you're leaving on the table.
Yeah. But I was just amazed when I talked to people that just said, "No, I don't want to get involved with it." And I said, "Well, what are you making in your savings account?" And
What savings? That's my tax refund.
And so we tried to talk them into doing it, and I was shocked at people. And even when I explained to them, well, if, they got them, what was done about it? Well, you get your money back. You can't lose. So, but I had my whole department in it. Not there now. Any other questions on anything?
Yeah, I got one more question. Apple is number one, Amazon is number two, is that correct?
Based on clubs and individuals and
Okay,
and
why?
better investing.
I can't see one being that much more valuable than the other, yet you quoted Apple stock as being like $200 and some odd dollars, and Amazon's being $1,800 per
Right.
share. What would cause such a drastic difference on two stocks that I think are two companies that are pretty
There's nothing.
evenly matched value-wise?
A number of years ago, Apple was up over 1,000,
Yeah.
and they had a 10-for-1 split. Amazon, I don't think, has ever split their stock.
Okay.
But what a lot of companies will do, when a stock reaches a certain price, they'll split it to make it more affordable for people. Warren Buffett, Berkshire Hathaway, that's why it's over 200,000, has never had a stock split.
Wow.
He does not believe in them.
That's why you look at things like PE and EPS, not
Yeah.
the price of the stock.
Yeah, the price, Apple had a stock split, I don't remember how long ago, but I know a number of years ago they had a 2-for-1 stock, or 10-for-1, I think it was, a stock split.
Apple did?
Apple did,
Okay, that makes sense.
yeah,
There'll be a number of reasons why a company would do that.
yeah. Yeah, and the main reason is they want to make their stock more affordable. For years, my first stock I ever bought was RPM out of Medina. Tom Sullivan was the CEO. And I tell you, I love that company. You could go to their headquarters, sit and go through their offices, go to their annual meetings. And when Tom Sullivan ran the company, whenever their stock got above 25, he would split it. His son Frank's been in charge now for 7, 8 years, maybe 10, and he's never split it. But it went down to $7 or $8 a share. Now it's up over 50. So, so his philosophy is a little bit different than what his father's was.
Maybe having had to work through all those splits to,
Mm-hmm.
to figure his basis, he said, heck with this.
But,
I'll just keep
yeah.
this the same. I mean, that's a real nuisance. I'm sure that people, accountants who do taxes, love stock splits
Mhm.
because it keeps them really busy.
Yes, it makes them more money, but again, a stock split doesn't improve your money. Doesn't make any difference. If you have 100, let's say you have 100 shares that are valued at $100, and they have a 2-for-1 split, so now you got 200 shares valued at $50. It's the same dollar amount. But what happens is a stock split tendency is to go back up. Now, a reverse stock split is just the opposite. To me, I've gone through a number of them, and they've always all turned out bad. Whenever I see a reverse stock split, I want to get rid of it. If I look at RPM here, it's $60. It closed at 60 today. It was over 50. A reverse stock split, let's say that you have 1,000 shares, and the price drops to under $1. It gets to be where it's a penny stock. What they'll do is maybe a 10-for-1 split, where now you have 100 shares at $10 instead of 1,000 shares at $1. Still worth the same amount of money. But what happens is a $10 share just seems to keep going down until it gets back to the $1. So my advice is,
When you have a stock, a good stock, that has a buyback, they don't wanna give a dividend. They wanna use the money for a buyback. But it never seems to, even if they buy 1 billion shares back, they don't go nowhere.
yeah, a lot of people don't appreciate buyback. What that does is just reduce the pie.
Yeah.
That's all it does.
And shouldn't you think that the stock should have went up?
Yep. Usually it may take some time, but all of a sudden you'll see the earnings start going up because they're not splitting it up in as many people. But yeah, a lot of times when they do have buybacks, you don't see it go up right away.
Well, sometimes the best thing the company can do is invest in itself because there aren't any other good investments out there that have good PEs and stuff like
Right.
that. So they buy themselves.
They buy it back
Yeah.
because that's the best they feel they can do with their extra cash, rather than give it to you or me. Let's just reduce the people and the amount of money we're going to pay.
I always thought of that as a loser.
It's a loser.
Get the hell out of it.
Yeah. Again, there's different philosophies in that. That's like, to me, a reverse split is a loser. Get rid of it. And that question?
Oh, just a comment. I worked for General Motors, and General Motors, one of the things Roger Smith did, he may have had cookie cutter cars and they all looked alike. But he bought EDS, and we used to joke, electronic data systems, that EDS dragged General Motors kicking and screaming into the 19th century. You know.
Yeah.
And one of the things that they did is the guy that was in charge of EDS didn't understand the uproar with all the employees.
Places like Fisher Price, all these things going on.
He didn't understand the uproar with the GM employees, and they started talking union, and so one day he disappears. You know, one of those midnight CEO or thing, head of EDS is gone. It was always Ross Perot for years and years. And along the way they said, "Well, we'll give you stock." And we looked at it, and while during the time that they distributed over, it was like 10 years, I think it was. They split 3 times. And every time it split, and almost in that year, it went back up to the price it was before. And I know there were several vacations we took, thank you, EDS, and it worked out real well, not to mention the IT work kept us busier than,
Yeah, stock splits to me, you talk to a lot of the financial analysts and they'll say it's a non-event. But to me, I'm with you. and that when they do a stock split, the price usually tends to go back up.
Yeah, well, it was, and General Motors needed EDS to kick in the gas.
Yeah,
They were not, their technology just was literally 4 years behind. It was never going to improve. They were, Y2K, they were still using punch cards.
oh gee.
It's like, here comes 2000, one of the things that cured that was machines
Yeah.
didn't operate properly.
I can appreciate that. When I was working at York, we had production, and that we used card punches for that.
Okay,
And we'd had these two gals that would key, stuff in for the production line and that. And we had this window washer. And he's there cleaning the windows. I mean, this guy, long hair, beard, scratchy looking. And we're sitting there with our plant manager, CEO, and the head of the department. And he looks down and he taps the CEO on the shoulder. And he says, "Excuse me, sir." Very nicely, he goes, "Are those card readers?" He goes, "Yeah, why?" He goes, "Man, I didn't think anybody used those anymore."
The window washer critiquing you.
Believe me, they were gone in 6 weeks. In 6 weeks, those card readers were gone. But I still remember that because we laughed so hard. But that's why we got rid of them. Yeah.
Do you use any other websites when you're doing checking on investing things?
I use Yahoo Finance a lot. I like Yahoo. That's very simple and straightforward. When I'm looking up stocks and that, I'll use Yahoo Finance.
what do you think of Motley Fool?
I like Motley Fool. I read their books, Break the Rules, learn from that. I like them. They started with AOL. That's how they got started. They did a financial thing on that. And I think they provide a lot of good information for people investing.
Yeah, it's, I get stuff like Google Newsfeed, and there's at least one article every day from Motley Fool.
Yeah, I get a lot of email from them.
Social Security, IRA, 401k, whatever it might be, and it's good,
Almost too much.
overall, good practical advice.
Yeah, I read the Chronicle every Sunday when they're
Such
in
a
there.
good column,
Yeah.
Just they have good advice there. They'll have some books you can maybe read. They'll talk about the worst investments, and they'll have a company in there that they'll highlight.
I like who is this company?
Yeah, name this company. We used to use that in my class where I'd go in and we'd try to figure out who it was, and sometimes we'd just end up Googling it trying to figure out. I mean, I didn't know, but a lot of times the students would know what company it was. And that,
How long have you been retired?
2 years.
Oh, okay.
I've been retired for 2 years. And I don't check my stocks and do that as much as I used to when I was a teacher because I'm not in front of the computer all the time. But when I was,
You're not supposed to look at them every day.
I know. When you're teaching in that, you do that.
Set it and forget it.
Mm-hmm.
Any other questions? And we're gonna.
Have you ever heard of small companies from Workhorse?
No, never heard of it.
Is that the wrong
Yeah.
one? We whacker.
They're trying to, it's all electric stuff, electric vehicles, trucks.
Oh, yeah?
They had can't remember which UPS or something, gave them like a 600 order for the van, the big brown van, to be all electric, but still have backup for the engine. And they're in these big drones, all electric that they're trying to get Amazon back on. They've gone public, and I've been watching what I've read about them. They're a little hard up on cash, and he's always trying to find more investors.
Yeah.
A million here, a million there, but,
Potentially, it could be
yeah.
an up and coming
And
thing.
that's what I was wondering, because their stock is it's almost like penny stock right now, but I just.
Workhorse, is that it?
Yeah, Workhorse.
Well, let's see what it's.
I was just wondering if
Yeah, I had not
that's
heard.
something that, they're so cheap right now, but might they?
Yeah.
Looks like sales has taken a dive.
Maybe they were building that
That's what
plane
it
that
said.
crashed. Parts
Yeah, they have zero earnings right now. Everything is negative.
Yeah.
Let's see what their stock price is. 62 cents. It's a penny stock. I try to stay away from them.
And I was just wondering,
Yeah,
about
I
the
didn't-
company and stuff, is it,
Jeff,
you know,
before
might
you-
they
$10
get going? I mean, somebody's got a dream here of building these electric, you know,
Yeah,
gadgets, cars, well, trucks and delivery vans and drones.
yeah, a number of years ago, I invested in a company, and
Yeah.
I think the stock symbol was ABAC. They were making batteries for electric cars, and they went bankrupt.
Oh, well, if they can figure out a good battery,
But
my cell phone.
sometimes you take a chance, sometimes it works, and that particular time did not work for me at all.
Yeah, it's just that, you know,
Yeah,
bought a number of shares at 60 cents a share. You ain't losing that much.
More than the shares.
They take off.
To get up to $1, you're ahead right there.
yep. Okay, well, thank you very much for having me back. Appreciate it. It's always fun to talk to you guys. Well, that worked out better than using my own computer.
Good, I'm glad.
Do we have,
We're shy.
can we hear your name checked in?
Why is it not stopping?
She's legit. She even dropped her LCC student number.